You're dialed in here to the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, your host, Erik Ainge. Today's show has a title that might sound a little dramatic, so stay with me. It's called Triage. You can't schedule an emergency. That's right. Here's the whole idea in one breath. Here we go. Nobody gets to predict the next market crisis, and the folks on television pretending they can are putting on a performance, not a forecast. What you can do is be the team that's stocked up, steady, and ready when the call comes in. And this first segment is about that exactly. Preparation, not prediction. Now, I know triage is a hospital word. I'm smart enough to know that, and this is a money show. So let me say right up front why it fits. Triage means you stay calm. You don't treat everybody the same, and you handle the most important thing first with a clear head. That is not a bad description of smart investing in a scary market. And it's exactly what this team has done 5 separate times over the last 6 years. So let's introduce this team doing all this. Megan Hubbard, Jerry's daughter, used to be a first grade teacher at CAK, has a master's degree in curriculum and instruction. She's the one who takes the hard stuff and makes it easy for us. Jerry Goodman, my man, has been doing this for over 43 years. Certified financial planner, runs the money in-house alongside his son-in-law, Jared Hubbard. And then Susan Ainge, my beautiful wife, newest member of the team, and honestly, she's got the best job in the building. She's your advocate, you people listening right now, the one asking questions that you'd be asking if you were sitting up here doing this show with us. And then, of course, me, Erik Ainge, host of the Erik Ainge Show. Used to play QB at Tennessee, like long walks on the beach, and, you know, all that kind of stuff. All right, so, Jerry, let's start with you. I said, quote, you can't schedule an emergency. Unpack that, please.
Here we go. Erik, in 43 years, I have never once seen the next crisis show up on somebody's calendar. Nobody penciled in COVID. Nobody penciled in the fact that the banks were going to get shaky in 2023. Nobody knew on their calendar the tariff scare was going to happen last year. Nobody circled the software sell-off that we've gone through over the last year. Certainly nobody predicted, and well, maybe somebody did, but nobody had it on their calendar about this Iran war that we're still kind of coming down to the end of. So we stopped trying to predict an emergency a long time ago, and instead we build basically our team being simply ready when the next one comes along. So think about an emergency room. The great ones aren't there because, they guess what's going to come through the door in the next 2 hours. They're great because they have the supply closet all stocked up and the staff is ready to go under pressure.
I love that, Jerry, because the panic is exactly the moment everybody else freezes up. The calmest person in the building during an emergency is almost always the one who's done it 100 times before. So let's start with you, babe. You've got the look of somebody who's about to ask a question that everybody at home is probably thinking too.
Okay, Jerry, I love the picture, but let me play the listener who's a little skeptical. Everybody says they're calm and ready. My old advisor said he was calm and ready too, right up until the market dropped and I couldn't get him on the phone. So what does a stocked supply closet actually look like inside a real portfolio? If I could walk in and open the doors, what's literally sitting on the shelves waiting?
Wonderful question, Susan. Answer is going to be really something kind of boring, which, that's the entire point, isn't it? The shelf is the steady stuff, okay? Dividend growth stocks that we call the DSIP list, Diversified Stock Income Plan, DSIP for short, okay? Includes little companies like Costco, Walmart, Home Depot, Smucker's Jelly, always a tasty favorite. Even Lowe's raised their dividend for that company for over 60 years in a row. So here's the quiet magic, okay? When the overall market drops, let's say 20%, these names are going to tend to drop much less. Sometimes they'll barely flinch. And that steadiness isn't just comfortable, it's ammunition, okay? The stuff that really doesn't fall exactly what we're going to sell to buy the stuff that did drop a whole lot.
Okay, wait, say that part again, because I think that's the whole trick, and I almost missed it. You're telling me the boring, steady stocks are actually the source of the money you used to go bargain hunting. So the calm part of the portfolio is what pays for the bold part.
That's exactly it, Susan. And that's the piece most people get completely backwards. When fear hits, the average investor freezes, or worse, sells the good stuff in a panic at the bottom. This team does the opposite. They go shopping and they pay for the shopping trip by trimming the calm, steady names that held their value. It's like keeping room in the pantry at home so that when you go to the grocery store suddenly and they have a fire sale, you can actually have the room and the budget and the freezer to stock up. The pantry is never the exciting part, but the pantry is what makes the fire sale possible.
All right, I have to admit, the pantry picture makes it click for me. Almost everything I hear about investing is pure adrenaline. Get in, get out, beat the market. Nobody ever told me the calm, full pantry was the actual secret weapon.
And that's the part that took me a while to get to. In football, everybody remembers the Hail Mary, the highlight, the crazy throw, but championships are almost always won on the boring stuff, the blocking, the tackling, ball control, all those things, special teams, not making mistakes, the parts nobody ever puts on the highlight reel. The dividend stocks are the blocking and tackling. The bargains, they're the highlight throws. You need both, but the boring part is what makes the exciting part even possible. And see, now this is a part I actually understand because it's football. All right, I think there's a lot of similarities here. You don't drop the game plan during the 2-minute drill. By the time it's chaos and the clock's running and there's no time to think, you install the whole thing Monday through Friday in practice. You know when that moment comes and you're on the field, you already know what to do. They're not inventing a plan when the market panics. They wrote it down months earlier and they've been doing this for years. So Megan, that's really the whole difference, is it not?
It absolutely is, Eric. Discipline is a decision you make in advance. And even though you don't know what the next crisis will be, you need to know how you're going to react to it. You have to figure out what happened, and if there's an opportunity, you can take advantage of it. So when the fear finally shows up, you're mentally ready to react to it. There is only execution. The thinking was already done back when everybody was calm and nobody was scared.
Quick one before you go on. When you say they'll trim the steady names, doesn't that mean selling my safest stocks at the worst possible time? That sounds backwards to a nervous person like me.
It feels backwards, Susan, but here's the trick. The steady names barely fell, so you're selling something that may still be a near full price. You're not dumping your safe stuff in a panic. You're calmly moving money from what held up into what just went on sale. It's the most boring, sensible trade in the world once you see it that way. During COVID, a lot of things hardly dropped much at all, while travel and hospitality stocks got really clobbered. So that is what we were buying back then.
Well, that's a relief to hear, honestly, because the scariest part as a regular person is feeling like everything's being decided in a panic. So before we move on, when you say this whole approach actually works, can regular people see the real numbers, or do we just have to take your word for it like every other ad on the radio?
You should never take somebody's word for it, Susan. You should always kind of watch for the scoreboard, for your advisor. And basically ours is really easy to check. Now in 2025, our average client was up 36.3% net of any kind of fee or cost. That's 36.3%, I'll repeat it, versus 13% for the Dow Jones average for the same year. Our 3-year average, 19.3 versus 13.2 for the Dow. 5 years, 13.3 plus 9.4 for the Dow. And our 7-year number, we're at 16.7%, folks, versus 10.1 for the Dow. Now, here's how you can verify all that if you really want to know. Go to theorganizedinvestor.com. We have every one of those returns posted on there, along with the last 4 digits of all those account numbers that are real. Basically, our clients can go look at them if they wanted to. And to be clear, this is not luck. This basically is not owning a little bit of everything with 20 different mutual funds in what we call diversification. It comes from being selective. How about that? Past performance, as we said many times, no guarantee of future results. Investment returns are going to vary based on the investment objectives and the tolerance for risk for each of those accounts.
Okay, the account numbers, that actually matters to me because anybody can print a number on a website. But Jerry, here's a question underneath all of it. Why does any of this make a real difference to my life? If I'm sitting at my kitchen table, why should I care whether I beat the Dow by a few points?
See, now that's the right question. All right, so Jerry, walk folks through the 2% and what it actually buys them.
Love the 2%, and we actually just made this goal up. It didn't really come from anything super complicated. The goal is to simply say, beat your prior advisor or some comparable benchmark by at least 2% a year. Now, 2% may sound kind of itty bitty, but almost not worth mentioning, but it's anything but tiny. Now, on $1 million portfolio, compound 2% over 20 years. That works out to be $485,000 of additional money. Folks, that is a house, a nice house. And it doesn't come from magic. It comes from 4 specific areas, okay? 1, lower fees. We charge up an advisory fee about 1/4 point less than your advisor is probably charging you. 2, we have lower cost. Why? Because we avoid mutual funds and all the expense ratios and the 12B1 fees all buried inside of that. Number 3, we have less diversification, which basically means instead of owning 4,000 companies, we own 95 stocks that we specifically selected. Again, instead of owning this massive portfolio and a bunch of funds that we don't even know what's in it. And 4th, being more selective, We use a DSIP list, diversified stock income list, as our core. Plus, we like to look for bargain opportunities, where we're going to spend the whole lot of the show on today.
Okay, $485,000. That's not a rounding error. That's a whole second retirement. And you're telling me it doesn't come from one big home run. It comes from 4 steady little edges just added together over time?
4 little edges, okay? That's really the whole philosophy in a nutshell. They're not swinging for one miracle stock that makes the decade. They're stacking small, repeatable advantages on top of each other year after year until they add up to a house or whatever it is that you want.
And Dad, that 4 source, the bargains, that's really the headline today, right?
Yep.
Because in almost 30 shows, we have mentioned these bargain opportunities 100 times, but we've never actually slowed down and walked through them one by one. Today, we finally do that. And the thing I want listeners to hold on to is that every single one of them was different from the last.
Different how? A crash is a crash, isn't it? If you've got one good strategy, why doesn't the same move just work every single time?
That's the exact thing we're going to break open in segment 2, Susan. And the short answer is no. A crash is not just a crash. Each one hits a different part of the market at a different speed for a different reason. Treating all of them the same way is how people get hurt. Reading each one on its own terms is how you win.
All right, let me hit the pause button right here, everybody, and tell everybody about the workshop. All right, because this is where you get to see all of this up close and in person. It's the Organized Investor Workshop at Chesapeake's on Parkside Drive in Knoxville, 6 p.m. once a month. There's a great meal, adult beverages, and you walk out of there with a 60-page workbook, and yes, you can win a football signed by me. It's not high pressure. It's not that steakhouse pitch where somebody's trying to sell you an annuity before dessert. It's a classroom. It's a meet and greet with a really good dinner attached. Reserve your seat at theorganizedinvestor.com or call 865-415-2058. All right, now while we're on the theme of being ready before the emergency hits, there's one piece of readiness this team will literally hand you for free, okay? An unlimited annual subscription with our online partner, Trust and Will, and providing you a complete set of estate planning documents to listeners, completely free of charge, no cost, no obligation. That's a durable power of attorney, a healthcare power of attorney, advanced healthcare directive, and either a will or revocable living trust for you and your spouse, valid in all 50 states. About 75% of you, of people listening right now, have either done nothing or your documents are badly out of date. This package is right for about 95% of folks listening. The other 5% with a complicated situation, well, we can introduce you to a flat fee attorney for that. And to get started, all it takes is a 5-minute phone call with Jerry or Jared to figure out which group that you're in. And you don't have to be a client. You don't have to attend the workshop or come in the office, although I highly recommend you do those things. But for this, you don't. They've been helping people with this for over 25 years, never made a dime on it, not once, because estate planning is the one decision that is a hard deadline that you don't get to see in advance. Got to be prepared. So call Jerry at 865-415-2070. Again, Jerry Goodman at 415-2070.
Call before midnight tonight.
Free. And they've never made a dime on it in 25 years. Okay, so what's the catch? Everybody at home is assuming there's a catch. Why would anybody just give that away?
I asked them the exact same thing, and the answer is refreshingly simple. It builds trust, and trust is how you earn clients over the long haul. They'd rather help 1,000 people for free and earn a handful of clients than nickel and dime everybody who just picks up the phone. There's no catch. It's genuinely just a good front door, good old-fashioned offer.
Jerry, can I grab one of your quick lessons before we wrap up this segment? Why do smart, successful people end up buying high and selling low over and over and over again? Because I've done it and I felt smart the whole time I was doing it.
So here's what we like to call smarter in 60-second comments, Susan. Investors have a powerful tendency to get drawn into the market when it's rising. And everybody kind of feels all great about this. Then what happens? They get scared out when it starts to fall and everybody feels awful. This is exactly backwards from how you should actually shop for anything else in your life. And learning to feel that pull and then not obey it, that's part of the whole game here, the most important part.
Drawn in as it rises, scared out as it falls. Jerry, that is painfully accurate. So basically, my own feelings are a contrary indicator. When I feel the most confident, that might be the single riskiest moment.
Susan, you just summed up behavioral finance better than most textbooks do. The goal isn't to stop feeling the fear. Nobody can do that. The goal is to stop letting the fear drive the car.
So on the free estate planning, maybe you're sitting there waiting for a sign. Folks, here's your sign flashing. Wow, 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 wow. The sign is this guy on the radio telling you that we will do it for nothing. So what are you waiting on, guys? All right, coming up in segment 2, we're going to do some rounds here. 5 different patients, 5 completely different emergencies, and exactly how this team treated each one, because not any 2 of them looked anything alike. So stick with us right here. It's the Organized Investor Show, brought to you by Tennessee Wealth Management.
You mean rounds for the hospital?
I think so.
Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, July 29th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, brought to you by Tennessee Wealth Management. I'm Ainge, Erik Ainge, not to be confused with Bond, James Bond. Hey, you know, Bond was at a bar one time.
Really?
Yeah, and he walked in, and there's a chicken in there, and he's talking to the chicken. He says, "Hey," he says, "I'm Bond, James Bond," and the chicken replies with, "I'm Ken, Ken."
Love it.
And we're stupid, but not really. Okay, quick recap. Segment 1 was about being prepared instead of trying to predict and keeping that steady stock supply closet of dividend growth stocks ready to go. This segment, we do some rounds. 5 patients, 5 diagnoses, 5 different treatments, quick reintroductions. Megan, Susan, Jerry, me, Ainge, Erik Ainge.
Thanks, Erik. I'm Megan. Megan.
Well done.
We'll just keep this going all day.
I thought you were
Well done.
Hubbard. Megan Hubbard.
Well, that's a lot. All right. Anyways, here we go. We actually need to talk about something that is relating to what people want to hear us talking about. So thanks, Erik. Here's the big idea for this segment. Every one of these bargain opportunities was a real emergency, and not a single one was treated the same way, because not a single one was the same kind of emergency. A good ER doctor doesn't walk into every room and do the exact same thing. I hope they don't. That would be horrible. He reads the patient, okay? He looks in front of him right now. What does this person need? So let's walk the hallway together. Let's go into 5 different rooms. Dad, why don't you take us into room number 1?
Oh, you mean me? Like Goodman, Jerry Goodman.
Yes.
Anyway, so room 1 is, we're going to call it the spring of 2020, during the wonderful COVID little situation we all enjoyed. That night that every single alarm in the building went off all at one time. You know, it wasn't one sector. It was the whole economy through the doors all at the same time. Travel, hotels, restaurants, airlines, cruise lines, all marked down 50 to 75% in a matter of weeks. Meantime, our steady little DSIP stocks, our dividend growers, some of those barely dropped at all. We had Smucker's Jelly down like 3%. So what did we do? We took that segment that we just described. We sold the calm names that had held up very well, and we moved some of that money into all the stuff that had been cut in half.
Jerry, hold on, because I lived through that and I remember the feeling. Everybody on the news was saying the world was ending. Businesses were closing. Nobody knew when it would stop. How on earth did you have the stomach to buy airlines and cruise lines while everyone else was running for the exits? Wasn't there a real chance some of these companies just disappeared?
It's a completely fair question, Susan. And the answer is how we did it, okay? We spread clients out from being roughly 49 companies invested in all these DSIP stocks we spread it out into 49 other COVID-affected stocks. So at this point, we had about 1% in all 98 different companies. So we were so diversified into a couple of these, we even said to the clients, if a couple don't survive, it really wouldn't make any difference. Now, they all did survive, but the math was really simply too good to ignore. So about a year and a half later, our biggest job then was calling up the CPA of our clients, basically to warn them how much gains we're getting ready to take from all these things that we bought the year before.
Good problem.
It was a nice problem. So, Susan, that's a really nice problem, as we always say, to have.
Okay, so the secret wasn't being fearless. It was being spread out enough that no single bad bet could sink you. Well, that makes me feel better, because be brave is not a strategy that I can follow. Don't put too much in any one thing. That one I can understand.
And that's the perfect takeaway, Susan. Notice the shape of that first one, okay? It was broad. The whole story was on fire, so the treatment was wide and very spread out. Dozens and dozens of names, a little bit in each. Now keep that shape in your head because room number 2 looks nothing like it. So Dad, take us into 2023.
We're going into room 2 now, making sure that no one is walking around with no clothes on. That was a regional banking crisis, 2023. And this one really wasn't quite as big as the first one, but we made a lot of money off of it still. A couple of banks failed because interest rates had risen a great deal, and the fear kind of washed through the whole banking sector. So what do? We went out and bought basically 13 regional banks, some of them beaten down quite a bit in price. This was all kind of, again, mostly smaller in scale, but again, it was very surgical what we did. One sector, one targeted treatment, and it was very profitable, at least for the ones that we did, and the amount of money was involved.
Notice the scale change there, folks. COVID was dozens and dozens of names. The banking crisis is about 13 names. Same team, same call, but a totally different size response. That's not them being inconsistent. That's matching the medicine to the patient in front of them, to the situation, to the bargain, to the fear.
So COVID was the entire building on fire, and the banks were just one hallway with a problem. Jerry, is that what you mean every time you say each bargain is different from the last one? Because when you put them side by side like that, they really don't look anything alike.
That's exactly it, Susan. And that might be the most important sense in this entire show. Every one of these is different from the last one. Treat the next emergency like the last one before it, and basically you're going to get it wrong. You have to read the patient who's actually in front of you every single time.
And that's football to a T, Mr. Goodman, Jerry Goodman. Every defense you face shows you something a little bit different. You don't run the same exact play against the Ravens that you're going to run against the Bills. It's all about scheme and situational football and all these different things. You'd get your head taken off. It wouldn't work. You read the defense. This week, you call the play that beats what's actually in front of you. So, Megan, room number 3, I'm told this one happened pretty quick.
Fact is the word, Eric. Room 3 is the tariff scare in the spring of 2025. If COVID was the long all-hands night, this was the rapid response call, the kind where you act in minutes, not days. When the tariff headlines hit and the market wobbled hard, the team made over 12,500 trades in a single day. That is not a typo, okay? 12,500 is what I said. And that was the accurate number. And they didn't just trim the steady names to do it. They also had cash sitting in a high-yield money market fund, and they were able to put that to work as well. So it was fast, it was violent, and frankly, it was over almost as quickly as it started.
12,500 trades in one day. I can barely make one decision about my own account in a week. Jerry, is that even possible for a normal advisor? Or is that one of those things only your setup can pull off?
It's only possible how we've built this, Susan. And the tariff scare, that's basically why we ended up being 36.3% for the year 2025, okay? You simply can't make 12,500 trades in a day when you're locked in some type of a mutual fund. By the time the fund committee schedules a meeting to discuss, what they're going to do next, the sale rack is empty and everybody's gone home with all the goodies.
12,500 trades in a single day. I want everybody at home just to sit with that number for a second.
It was busy.
Not a guy checking his account on the phone at the stoplight. This is a team built on purpose, intentional, to move at speed that nobody else in the business can.
Well, wait, Jerry. You just said something I really want to stop on. Why can't a mutual fund just do what you did? What is actually physically stopping them? Because I think a lot of people listening assume their funds are doing this kind of thing for them.
That is the heart of it, Susan. Most people basically are in what we would refer to as a mutual fund advisory account. And that's a tough spot, okay? Here you are, you're paying an advisor maybe between 1 to 1.5% a year, sitting on just for putting you in a bunch of mutual funds that already have a charge associated with them. They have an expense ratio, 12B1 marketing fees, their own internal trading costs. So those 2 or 3 layers, basically, those fees compound against you every single year, whether the fund is even doing well or not. And here's the insult at the end. When you get around the end of the year, around December sometimes, those funds can actually hand you a capital gain bill for trades that the fund manager may have made back earlier in the year on stocks that you didn't even own, that you didn't choose. You could have an account that actually loses money for the year and still end up paying tax on it. So you're basically sitting in the waiting room while the committee basically is meeting once a month and hoping that things go right, but sometimes they simply don't.
A capital gains bill for trades I didn't even make, that genuinely makes me a little mad, Jerry. So I could lose money for the year and still get a tax bill in December?
Unfortunately, yes, it happens every single year. So you could be down, as I said a minute ago, for the whole year, and you still get a tax bill. So when you own what we use, individual stocks, that's basically the way our clients do it. You get to decide when the gains happen. You're the driver again. You're in control of it, and there's complete transparency. You know exactly what you own.
Being the driver instead of the passenger, that keeps coming up, and it's really starting to land for me. It's not only about returns, it's about who's actually in control of my own money.
Let me jump in here with the workshop because this is the stuff where we go even deeper, like when we're in the room. Again, the Organized Investor Workshop at Chesapeake's Parkside Drive, 6 p.m. once a month. We all get together. I say we all, Megan and Jared, they come and Jerry comes and I come and Susan comes. It's no pressure. It's not a sales trap. It's just the truth with a good dinner. You get a meal, adult beverages, 60-page workbook, shot at winning assigned Tennessee football. And when you go to theorganizedinvestor.com, it's super simple to RSVP right there. Tell your friends, heck, bring as many people as you want to. 865-415-2058 if you are the phone call person. So, Megan, before room 4, let's get a quick estate planning reminder.
Yes, quick and important. That full set of estate planning documents that we talked about is completely free. It's just a 5-minute phone call to get started, and you do not have to be a client. You don't have to attend our workshops, and you don't even have to come into the office to see us, although we would love for you to. Keep it in the back of your mind while we finish rounds at our make-believe emergency room here. It's the same exact theme as this whole show. Handle it before the emergency, not during it. Okay, so let's move on to room number 4. And this one's my favorite because it's the most understood of all the 5 rooms we're going to talk about. Room number 4 is the software sell-off, what we've been calling the soft disruption trade. And it's been building slowly for about a year. Over the course of a year, the whole market convinced itself that artificial intelligence was going to destroy the entire software industry. So every software company got sold off, the great ones right alongside the genuinely weak ones. This is the patient everybody wrote off as terminal, which is so sad, who actually just had a cold. Dad, this one needed a careful diagnosis, didn't it?
It needed the most careful diagnosis of all of them, Megan, because here the skill wasn't speed, it was selectivity inside the fear. That's kind of a big mouthful. But this sell-off dragged over a lot of quality companies that had real customers, real recurring revenue, the pricing power to raise rates every single year. Companies like Microsoft, Oracle, Adobe, DocuSign, Intuit, CoreWeave, ServiceNow. So we brought about 30 of these companies with about, say 1% each, with an average analyst upside, if you mathematically look at it, of around 50%. And we expect to hold these stocks around 12 to 18 months. And this isn't going to be a quick and in and out sort of trade. It's kind of being more basically a different kind of patient, a little bit different timeline.
So let me get this straight. The herd ran away from the healthy companies just because they happened to be standing near the sick ones? That sounds almost silly when you say it out loud, Jerry. How does the rest of the market miss something that obvious?
So here's one of our smarter in 60 seconds kind of comments, and it answers that pretty directly. Rising fear, much like rising interest rates, it doesn't carefully sort the strong companies from the weak ones. It sells everything in the neighborhood at the same time, which means that the moment when things feel the scariest is oftentimes when the healthiest businesses go on sale at a really big discount versus the sickest ones. The herd can't seem to tell them apart. Our job is to basically try to do that.
So the fear itself is what creates the bargain. The scarier it feels, the bigger the discount on the good stuff. That's kind of a comforting way to think about a scary market, actually.
It really is, Susan. Fear isn't the thing to run from. It's actually the thing that puts the good companies on the sale rack. But you have to be built to act on it, and you have to know which ones are actually healthy. That's the whole job.
Before we get to room 5, I think room 4 is the one that scares people the most, and it's worth saying it's why this team didn't flinch. When everybody on TV is screaming that an entire industry is finished, cooked, kaboom, walking in takes a kind of nerve that most folks just don't have. But it's not blind nerve. It's nerve plus homework, and that combination is exactly what gets paid. Okay, so Megan, bring us home. Let's get into room 5 here, and I hear this is the one where the only patient showed up with 2 injuries at one time.
Yes, that's right, Eric. 2 injuries, opposite directions. And this is the Iran conflict. The moment those headlines hit, two things happened at the exact same time. Travel got crushed, airlines, cruise lines, hotels, because tense geopolitics scares vacationers. And oil ran straight up because of fear about supply. That is the only one of the five where the right treatment was to buy one thing and actually sell another at the same time. So, Dad, walk them through both sides of this.
Here we go. So on the travel side, we went out and started buying some travel-related stocks like 3 cruise lines, 4 airlines, when basically the fear was the loudest. Because it wasn't just that the fear of traveling, but also these are companies that have fuel, that have to spend a lot of money on that, and the concern was higher fuel prices would hurt their earnings. Now, on the oil side, on the opposite side, we basically went through and sold a lot of the oil stocks that we had because they had run up a lot in price while prices were kind of high. So the fundamentals really hadn't changed much in the company, and it's all looked like just a big short-term kind of an issue, which has since gotten resolved. And we ask one question to decide in every geopolitical trade, kind of a mouthful there, is this permanent change in behavior or just a temporary fear? Now, after 9/11, after COVID outbreak, after Ukraine, travel always seems to get crushed and then recovers in a year or so. Temporary fear creates this buying opportunity for these patient investors. So we bought the fear in travel and basically sold the fear in oil.
Buy one and sell the other at the exact same time. That takes a genuinely steady hand. Most people freeze up when the news is that loud. This team had a plan for both sides before the sun even came up.
So you were treating two opposite problems in the same patient at the same time, calming one side down, helping the other side up. That's wild. And it's the clearest example yet of why everyone is different actually matters. If you treated Iran like COVID, you'd have gotten the oil side completely wrong, wouldn't you?
You'd have gotten it exactly backwards, Susan. Like in COVID, everything was a buy. Now, in this Iran situation, half of it was a buy and half of it was something you should sell. Same doctor, same calm, same supply closet, but a completely different treatment because there's a completely different emergency.
5 rooms, 5 patients, 5 totally different calls. And here's your short scoreboard reminder for the folks just tuning in. In 2025, average net rate of return, net of all fees for Tennessee Wealth Management, up 36.3% versus 13% for the Dow over 7 years, 16.7% per year versus 10.1%. Past performance, no guarantee future results, returns vary by account. There, I said it. And remember that 2% goal, that's $485,000 over 20 years. Comes from those 4 places: lower fees, avoiding mutual funds, less diversification, more selectivity, and the ability to do all 5 different rooms as they present themselves. Rooms 1 through 5 are that 4th source right there in action.
So here's your challenge before the break. You comparison shop everything else in your life. I know you're doing it. Your car, your phone plan, your homeowner's insurance. You would not be very smart if you weren't doing that. When's the last time, though, that you actually compared whether your accounts are even set up to do any of what you just heard in these 5 rooms? Think about that for a minute. What are you waiting on with that one?
It's a tough question, and it's a fair question. So coming up in segment 3, what happens after the emergency? How you stabilize the patient and send them home and get them back to normal, and what all of that means for you specifically. So don't go anywhere. This is the Organized Investor Show, brought to you by Tennessee Wealth Management.
If you're interested in a more personal learning experience, join us at an Organized Investor Workshop. Erik, Ainge, and the entire team will be there. The next event is scheduled for Wednesday, July 29th, 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. Attendees will receive a 60-page workbook, a yummy meal, and learn how to get free estate planning documents through our partner, Trust and Will. Seating is limited, so reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058. Erik Ainge is the host of The Erik Ainge Show on 99.1 The Sports Animal, weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management and Prospera Financial Services in Dallas.
Welcome back to the Organized Investor Show, brought to you by Tennessee Wealth Management. It's me, Erik Ainge, again here. Quick recap. Segment 1, prepare, don't predict. Segment 2, 5 emergencies, 5 different treatments, no 2 alike. This segment is about the part almost nobody ever talks about, the recovery. What happens after the crisis passes? Reintroductions, Jerry, Susan, Megan. All right, Jerry, the patient is stable, so now what?
Now you do the smartest, least glamorous thing in medicine, Eric. You basically discharge them, okay? You send them home. So buying the bargain is only half the trade. The other half is basically the round trip back. So we typically have these opportunities that will last 12 to 18 months. Then we try to rotate the money back into some of these steady DSIP, these dividend growing stocks, back to the home base. Now, if nothing looks attractive at the moment, maybe we're going to pull a bunch of this money into, say, a higher money market fund or something. So patience is basically, it's not a consolation prize. It's just part of the discipline.
That surprises me, Jerry. I would have thought the exciting part is the buying and that you'd want to stay in the winners as long as humanly possible. Why is going back to the boring dividend stocks just as important as the bargain hunting?
Because the boring dividend stocks are what fund the next emergency, Susan. If they stayed fully invested in the exciting bargains forever, they'd have no steady names to trim the next time fear shows up. The round trip isn't retreating, it's reloading. And those DSIP companies pay a growing dividend the entire time you wait. So you're actually getting paid to be patient.
And the part about just sitting in cash when nothing looks good, that almost feels lazy to me. But I'm guessing it's actually the opposite. Is it hard to just not do something with the money?
It's the opposite of lazy, Susan. Sitting still is one of the hardest disciplines there is. Forcing a bad trade just to feel busy is exactly how people lose money in a quiet market. Sometimes the smartest move on the whole board is to do nothing and wait for a pitch worth swinging at.
And that patience is only possible because of how this team is built. When you manage about 95 stocks in-house, you can hold cash, you can wait, or you can pounce. It's entirely up to Jerry and Jared. A committee running a giant mutual fund, they can't just sit in cash and tell investors that they're waiting for a better day. They have a mandate. They have to stay fully invested, good prices or bad.
Oh, I like that. So even the boring waiting period is still paying you. But Jerry, let me ask the hard one. How do you know when to come home? How do you not get greedy and just ride the winners too long?
We watch for what the original reason was for the bargain to have finally played out. So, whether the fear has kind of faded away, the prices have recovered back to where we think maybe they really should be. So when the discount is gone, the reason to own the name is probably gone as well. So we got to go back home to our little safe dividend-paying stocks, where it's kind of easy to stay. It's not tempting to leave.
So the discipline cuts both ways. Brave enough to buy the scary thing, but humble enough to sell it once it's worked. That second part honestly sounds like the harder one.
And Susan, this is where being in-house with about 95 stocks really earns its keep. Jerry, my dad, and Jared, my husband, can move out of DSIP and into the bargains and then move all the way back entirely on their own timing. The person stuck in the mutual fund advisory account can't do any of this. They're a passenger the whole ride. They can't buy the fear, they can't sell the winners at the right moment, and they certainly can't pick a calm spot to sit in cash and just wait for the next opportunity.
Reloading. That's what this trip home is, really, isn't it?
Yeah.
In football, you don't celebrate on the field after a touchdown and forget that there's a whole other drive coming. You jog back to the sideline, you reset, you catch your breath, you talk, you get a plan, and then you go execute. Coming home to those dividend stocks is this team getting back to the sideline to reload for the next series.
So the mutual fund person is basically stuck on the ride, whether they like the ride or not. They can't get off, they can't change direction, and they get the tax bill at the end anyway.
That's the whole picture in 2 sentences, Susan. They're paying premium prices for a seat where there's no control. We'd rather control the situation in the right way for each account individually.
And here's your football version, because, of course, there's got to be a football version. When you've put together the big drive and you're up 2 scores late in the fourth quarter, the smart team doesn't keep airing it out and keep taking wild risks. You protect the win. You get into 4-minute offense. The ball's more important than the yards. Make sure you stay in bounds. You run the ball. You take what the defense gives you, and you get to your base offense. Coming home to those dividend stocks is the base offense. You don't win by trying to be a hero on every single snap. You win by knowing the situation, right? When the big drive is over, when it's time to protect the lead.
So even the way you exit is disciplined. You're not trying to squeeze every last dollar out of the trade. That's honestly the opposite of how I've always pictured aggressive investing.
And aggressive is the wrong word for it anyway. It looks more like a well-coached team than a riverboat gambler. Boring on purpose, bold when it actually counts, disciplined enough to walk away with the win in hand.
Well, and here's what I keep coming back to, though. A lot of people honestly have no idea which kind of account they even have. How does somebody listening right now figure out whether they're the driver or are they the passenger?
Easiest tell in the world, Susan. Just look at what you actually own on your statement, okay? If it's a list of individual companies, Costco, Microsoft, and airline, you're probably in the driver's seat. If it's a handful of funds with names like Growth Fund Class A, you're very likely a passenger inside a mutual fund advisory account paying for a seat you don't get to steer.
Time to get my workshop talk in here right in the middle, because this is exactly the kind of thing that we map out in that room. Right? The Organized Investor Workshop, Chesapeake's Parkside Drive, 6 p.m. once a month. You get a meal, adult beverages, a 60-page workbook with a ton of useful things and information in it, chance to win a football signed by me. It's education. It's no pressure. There's no traps. You get to come see us, meet us, put a face to the name, and then also talk about your life. This is your life. No pressure, no traps. Reserve your spot, theorganizedinvestor.com, or give us a call at 865-415-2058.
Okay, Jerry, give me the practical version, because this all sounds great in a studio. If somebody's listening right now and they like everything they've heard, how do they find out if their money is actually set up this way? What should they literally go ask their own advisor on Monday morning?
And 3 plain questions, Susan. And listen carefully to whether you basically are going to get a plain answer. Number 1, let's just say when the market cratered over the last year, say in the software sell-off or basically the Iran scare, did you call me with a plan, basically, or did I have to call you and I got kind of panicked? Or question 2, can you actually buy individual stocks for me when they're on sale, or am I locked into, say, these mutual funds where I really can't do anything? Or the third question, what did I really pay you last year in total actual dollars? Tough question, but it's a question you should ask with every single layer included, okay? Even the fees and the costs buried inside of those funds. Now, if the answer is a little bit fuzzy, basically, or they've changed the subject even, that could happen. That itself was going to tell you something, okay? If you bring your statements to our workshop, we're not going to sit there and try to spend 30 minutes and decode it, because there'll be several people there. But we're happy to sit there and have a chat with you, and even be happy to take a quick look at them if you want us to.
3 questions, and you'll learn everything you need to know by how fast you get a straight answer. A confident team answers all 3 in about 10 seconds flat. Boom. A nervous one starts reaching for the brochure.
I love that those are questions a normal person can actually remember and use. And honestly, the first one might be the most revealing. Did they call me, or did I have to chase them?
It's the most revealing of the 3, Susan, and it tells you whether basically you're on the radar screen, in real time, or you're just a name on their list, okay? So here again, what we call smarter in 60 seconds to kind of close down.
I love these.
Exactly. The hardest part of this whole strategy, it isn't the courage to buy when everybody else is scared, okay? Plenty of people can manage that at once. The hard part really becomes when you actually have to go back home, when the opportunity is over, instead of just getting greedy and kind of staying around a little too long. So knowing when to leave the table is also separates from a real strategy from just being a lucky streak.
So if my advisor goes quiet, changes the subject, or just can't give me a straight number, that silence is the answer. I don't even need him to admit anything. The dodge tells me everything I need to know.
That's the whole thing, Susan. Clarity is a feature of a good setup and the first casualty of a bad one. If somebody can't tell you plainly what you own, what you pay, and what they actually did for you in the last crisis, the fog is not an accident. And let's tie it right back to the goal, because everything connects. That 2% improvement, about $485,000 over 20 years on $1 million portfolio, comes from 4 places: lower fees, avoiding mutual funds, less diversification, and more selectivity. Everything you heard today, the buying and the coming home, and is that 4th source quietly doing its job over and over for years on end.
So the bargains aren't some side hobby. They're literally one of the 4 engines behind that $485,000. Well, that reframes the whole thing for me.
Exactly, Susan. It's not a magic trick on the side, okay? It's one of the 4 engines running the whole time. And it only works because the other 3 engines are running too.
Can I ask the question that's really underneath all of this for a regular person? After hearing all 5 emergencies, is the real product here better returns, or is it being able to sleep at night when the news is terrifying?
Honestly, Susan, it's both, and they feed each other. The calm is what lets them act instead of panic, and acting instead of panicking is exactly what produces the returns. A scared investor sells at the bottom. A prepared team goes shopping. Same market, completely different ending.
And that's the quiet superpower nobody puts in an advertisement, folks. It isn't a hot tip, and it isn't flashy. It's a system that lets calm, prepared people do the exact opposite of the panicking crowd over and over and over again.
Okay, can I try to say the whole show back just to make sure that I've actually got it? You keep a calm, steady core that may not drop much in a panic. When fear creates a bargain, you sell some of that calm stuff and buy what's cratered. And you do it differently every single time, depending on the emergency. Then you hold it 12 to 18 months, sell once the discount is gone, and come all the way back home to the steady stuff or to cash if nothing's on sale.
Susan, you just delivered the entire show in 3 sentences. I might steal that for the workbook. That's it exactly. Prepare instead of predict. Treat each emergency on its own terms, and then come home and reload. And the only way to actually run that playbook is to be in-house and own your own individual stocks, not stuck as a passenger inside of 15 to 20 mutual funds.
And one more time on the free estate planning, because it's the exact same lesson of the entire show. Handle it before the emergency, not during it. It's free. It's a 5-minute phone call to start, and you don't have to be a client or come to the workshop or even come in the office. So, Megan, real quick on that.
Think about it this way and be honest with yourself. What happens if you keep waiting on those documents? Best case, nothing happens and you got lucky. Worst case, your spouse and your kids are the ones who pay for it at the worst possible moment when it's already too late to fix. That is the one decision with a deadline you don't get to see coming.
So here's the simplest call you're going to make all year long. Pick up the phone. You can reach me directly. This is Jerry Goodman. My phone number, 865-415-2070. Again, 865-415-2070. It rings directly to my phone. Either myself or Jared Hubbard, we would need to have a brief little chat with you to make sure that you are in the 95% easy-to-use kind of group, the simple group, who doesn't actually need an attorney. If you are, and most people are, we're going to send you a link. You can do this completely on your own, or we'll still even help you with it a little bit on our own for no fee if you need us to do that as well. So please think about this. It doesn't get any cheaper than free, folks. It can't.
It sure doesn't. All right, that's our whole show. Here's the whole thing in one sentence. You can't schedule the emergency, but you can absolutely be the team that's ready for it. 5 emergencies in 6 years, every one of them different. Everyone handled with a stocked up supply closet and a calm head. That's preparation beating prediction. And it's the whole reason that the clients at Tennessee Wealth Management can sleep at night when the headlines get loud. And the proof is right there on the scoreboard, guys. Up 36.3% last year versus 13% for the Dow, and 16.7% a year versus 10.1% for the Dow in that 7-year period. For the workshop, guys, grab your seat. Tell your friends. Chesapeake's. You can RSVP at theorganizedinvestor.com or call 865-415-2058 for your free estate planning. Call Jerry directly. Take you 5 minutes. 865-415-2070. It's going to go straight to him. 415-2070. Thanks to Megan. Thanks to Jerry. And thanks to you, Susan, the listener advocate of the show. Remember, past performance don't guarantee future results. Returns vary by account. It's the Organized Investor Show, brought to you by Tennessee Wealth Management. We'll see you next week.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of the Organized Investor or Tennessee Wealth Management. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Erik Ainge is the host of the Erik Ainge Show on 99.1 The Sports Animal weekdays from 9 to noon. Erik, his wife Susan, Megan Hubbard, and Jerry Goodman are all affiliated with Tennessee Wealth Management in Knoxville and Prospera Financial Services in Dallas, Texas. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning or before making any investment decision. And please consult legal or tax professionals for specific information regarding your individual situation. Brokerage and advisory services are provided by Tennessee Wealth Management through Prospera Financial Services, Inc., member FINRA SIPC. The Organized Investor is a brand name operated by Tennessee Wealth Management for educational platform purposes. Want to meet the team from the Organized Investor in person? Join us at a free Organized Investor workshop. You'll get a 60-page workbook, a great meal, and learn how to get free estate planning documents through our partner Trust and Will. Our next workshop is Wednesday, July 29th at 6 p.m. at Chesapeake's Restaurant on Parkside Drive in West Knoxville. There's no cost or obligation to attend. However, seating is limited. So reserve your spot at theorganizedinvestor.com or call 865-415-2058. That's 865-415-2058.